All right, let's dive into UiPath's latest earnings report. This one was a real head-scratcher. The company put up great numbers, but the market absolutely hammered the stock. So we're going to figure out what on earth happened.
So here's the puzzle, right? On one side, you've got a fantastic report card. UiPath beat expectations across the board. On the other side, the stock just plummeted the very next day. What gives? Let's unpack the numbers, the narrative, and the guidance that caused this massive disconnect. Okay, first, let's talk about the actual results for the quarter. Because, on paper, this was a really solid performance. The kind of thing that should have investors popping champagne corks.
And when I say solid, I mean it. They didn't just beat estimates, they blew past them. Revenue was over $481 million. That's $16 million more than expected. Earnings per share, 30 cents, a full 20% higher than Wall Street was looking for. And annualized recurring revenue, ARR, hit $1.85 billion. Seriously, by any standard metric, these are just impressive numbers.
And this wasn't just about one good quarter. Management was really eager to point out a huge milestone for the company, their first full year of actual honest-to-goodness GAAP profitability. We're talking $57 million in operating income. For a software company that's been in that growth-at-all-costs mode for years, this is a massive operational win.
So, with a great quarter in the bag and a huge profitability milestone reached, what's the story they're telling for the future? Well, it's all about AI, specifically something they call Agentic automation.
The founder and CEO, Daniel Deans, really nailed their whole argument with this one quote. The thinking is, as AI makes its way easier and cheaper to create automations, companies aren't going to need less help managing them, they're going to need more. They'll need a robust platform like UiPath that control the chaos. It's a pretty compelling idea.
And they came with proof. Their AI products now account for nearly $200 million in ARR. And maybe more importantly, the number of big customers, the ones spending over $100K a year, who are also buying AI products, shot up 25%. That's not just hype, that's real traction with their best customers.
The momentum is definitely there. I mean, look at this. 16 of their top 20 biggest deals this quarter had AI baked in. They also snapped up a company called WorkFusion to beef up their financial services expertise and launched new AI agents for healthcare. So yeah, the AI push is very real.
Okay, strong quarter, profitable year, a killer AI story. You'd think the stock would be soaring, right? Well, here comes the but. It all came crashing down with one thing, the guidance for the next fiscal year. This is where the whole story's sour.
And this slide, this right here, is the smoking gun. It tells you everything you need to know. Revenue growth, which was a respectable 13% last year, is projected to slow down a lot. Same story for ARR growth. This is the giant red flag that the market just couldn't ignore.
And here's the number that caused all the pain. Their guidance implies that revenue growth is going to drop to around 9%. 9. For a software company that trades on a growth story, falling into the single digits is like a death knell for investor sentiment. It's a huge problem. So, as you can probably guess, the market saw that slowdown coming, and the reaction was, well, it was brutal. Wall Street delivered its verdict, and it was swift.
By the end of the next trading day, the stock was down over 8%. There's no mystery here. The weak guidance completely overshadowed that great quarterly report, and the sellers came out in force.
And this wasn't some quiet little sell-off. The stock dropped on absolutely massive volume. We're talking over 91 million shares traded. That's nearly 3 times the average. Volume like that tells you the big money, the institutional funds, were the ones hitting the sell button, hard.
And of course, right on cue, the Wall Street analysts started tripping over themselves to cut their price targets. We saw downgrades from UBS, Morgan Stanley, Wells Fargo, pretty much everyone. The message was clear. The slowing growth was a major concern.
So after all that, where do we land? Let's put the good and the bad together and come up with our final take on the stock right now.
So the bull case is pretty straightforward, right? The company is executing well, their AI strategy seems to be working, they're actually profitable, and they're buying back stock. But the bear case is just so much simpler and more powerful at the moment. Growth is slowing down, big time.
For us, this all balances out to a market perform rating. Look, the company is doing a lot of things right, and the AI story is really compelling. But the stock is probably going to be stuck in neutral until we see some hard evidence that growth is picking back up. The market is firmly in show-me mode.
And now for our not financial advice trade idea.
With all the fear in the stock right now, volatility is really high. So one potential play is to sell cash-secured puts. You basically get paid a high premium to agree to buy the stock at a lower price, a price you'd be comfortable owning it at anyway. It's a way to get paid while you wait.
So, looking ahead, here are the 3 things you need to watch. First, they have an Agentic AI Summit on March 25th. Does that create any real excitement? Second, keep an eye out for any news about that WorkFusion acquisition helping them land new deals. And finally, listen for any change in tone about ARR momentum. Is it stabilizing or, even better, re-accelerating?
So, UiPath is really at a crossroads. You've got this great execution and a really exciting AI story running headfirst into a wall of slowing growth. The big question is which of those forces wins out. The market is waiting for a signal, and remember, this is not financial advice.